It's a pleasure to join you, and thanks for coming tonight. Yeah, it's my task basically to set the landscape for what the economic backdrop looks like and how that might affect you as a small business owner. Before I get going, though, and if you were with us last year, you know I like to do this. I'm just going to conduct a quick straw poll just to ask you whether you are optimistic, cautious, or pessimistic on the Canadian economy over the next year. And I guess how I would define an optimist, it would be someone who would believe that the recovery we've seen so far will actually strengthen and improve upon itself over the next year, whereas a cautious person would believe that what we've seen is about as good as it's going to get, and if, you know, at best we're going to kind of muddle along over the next year. And a pessimist would be, I would define it as someone who spends far too much time watching CBC or reading the Globe and Mail and actually thinks we're headed for another downturn over the next year. So with those unbiased definitions, how many people would consider themselves to be optimistic over the next year? Show of hands, any optimists? There must be some here. Okay, about maybe a fifth or so. How many people would consider themselves to be cautious on the outlook? Show of hands. Got a few Canadians in the room, I see. Okay, and how many people would consider themselves to be pessimists? Show of hands, please. No Globe and Mail readers, one back there. Thank you very much. And realistically, that is the very issue that the markets are grappling with on a day-by-day basis, and they cannot come to a firm decision on that very question. And when I say the markets, it really doesn't matter which one we look at, whether we talk about the Canadian or U.S. equity market, or the Canadian dollar, or commodity prices like oil or copper. They're all basically carving out the exact same pattern in recent years. They're almost totally correlated and sending the same message at any one time. And I would suggest that probably in the latter half of last year, for all intents and purposes, the optimists left the building, and really it was a debate between the pessimists and the cautious folks over there, whether we were actually headed into another outright global downturn. And a lot of the concern was over Europe. But as my title suggests, if anything, the markets are starting to look past the problems in Europe. It's not like they've gone away, but they're starting to get a better idea of exactly the kind of risks we're dealing with and what the downsides are there from Europe. And they're looking more at domestic considerations, you know, what's going on in the U.S., whether the Chinese economy is going to go through a hard landing or not. And they're starting to lean a little bit more towards the optimistic end of the spectrum in the last couple months or so. So just cutting to the chase and getting to where we see the economy going over the next year, we think that growth, mostly led by a little bit of a pickup in the U.S., will do okay this year. Now, I realize that's the technical term for it, but basically what we're looking for is a little bit of an acceleration in the U.S. economy to growth of just a wee bit below 2.5% and something close to 2% in Canada. Now, to put those numbers into perspective, an average year for the Canadian economy over the last 25 years or so has been growth of about 2.5 to 2.75%, and a little bit stronger in the U.S. So we are looking at something a wee bit below average for both 2012, and that followed a slightly below average year last year as well. However, we do see the economy gathering a little bit of steam in 2013. The one thing I would point out there is we actually do see the U.S. growing a bit faster than Canada in 2012, and that'll be the first time in 7 years that the Canadian economy has trailed behind its U.S. counterpart. Now, that being said, the fact of the matter is because we've been growing faster than the U.S. over the last 6 years, there's a lot of catching up to be done by the U.S. economy. And one way to look at that is just in terms of the jobless rate or the unemployment rate. Right now, in the U.S., the unemployment rate is almost a full percentage point above that of Canada's. Even though there has been some narrowing of the gap in the last few months or so, the U.S. unemployment rate is still almost a full percentage point above that in Canada. That is very, very unusual. Over the past 30 years, for most of those 3 decades, the Canadian unemployment rate was above that of the U.S., and we turned the tables during this past cycle. A couple other things I would point out to you. With the improvement in the U.S. unemployment rate in the last couple months or so, you can see that the jobless rate is actually not that far away from where it was when Obama first took office back in early 2009. And, you know, even though there are a lot of warts with this measure, the fact of the matter is this is the number that's read out on the CBS News when they talk about the jobless situation. And so I think the economy will become a little bit less of a headwind for Obama as we approach the election. The other thing I would point out is when we center in more closer to home in terms of Ontario or Toronto, you can see that Ontario's unemployment rate is higher than the national average, and Toronto's is another step higher yet. And in fact, Toronto's unemployment rate is actually even above that of what we see in the U.S. right now. Now, we can also stack up both countries internationally. You can see that neither one is a particular outlier. There's all kinds of countries that have much higher unemployment rates than the U.S. For instance, take a look at Europe. Look at those jobless rates in Europe, 23% in Spain, 19% in Greece. And, you know, from that perspective, the U.S. jobless rate is actually not that high. On the flip side, there are countries that are in better shape than Canada, certainly. For instance, Germany and Australia stick out as examples. But again, the key point I want to make there is we have seen some pretty considerable improvement in both Canada and the U.S. over the last couple of years, but we've got some way to go before we get back to pre-recession levels. And one concern from the Canadian job perspective, and of course this has been in the news big time in the last 24 hours or so, is we are likely to get some restraint at the government level, both here in Ontario and certainly federally as well. And that will act as a dampener in the job market. You know, throughout the downturn and the early stages of the recovery, government actually was a big net hirer, and that did help the economy continue to expand, or at least the job market to continue to expand through late 2009 and 2010. But we've now seen government payrolls start to peel off, and if anything, they're going to weaken further over the next couple of years as we see the restraint deepen, particularly here in Ontario. Now, another area that's been in the news a lot has been Canada's housing market. By the way, I'll do a quick segue on the U.S. housing market because I think it's been very important to the U.S. economic story over the last 5 to 6 years. What we are seeing in the U.S. is finally, at long last, there is a little bit of a light at the end of the tunnel. The U.S. housing sector has been in, you can really only call it a depression for the last 5 or 6 years, but it does look like things are finally starting to turn around. Whether you look at sales or home building, it does look like things have finally started to turn the corner. Now, it's going to be a few years before the U.S. housing sector gets back to sort of a normal state of affairs. And when we look at prices, things still haven't turned the corner yet in terms of average home prices. But like I said, it does look like there is a little bit of a light at the end of the tunnel. In Canada, our housing sector, the concern is not over how weak it's been, it's over how strong it's been. And we've been on a little bit of a roller coaster ride in terms of our housing market. And one way to capture that is to look at home sales. We had a deep dive, a big comeback, a decline. But right now, if you look at sales or home building, recent levels, they're actually pretty close to the long-run average right now. Again, whether you look at sales or starts, they're pretty close to the long-run average. So for most aspects that I look at it, the Canadian housing market is actually relatively well behaved and not really out of line with long-term averages. But the one thing that people do focus on and center in on is that chart on the right, that gap we see between U.S. and Canadian home prices. Whereas average U.S. home prices have dropped by more than 30% before the recession began, we had this little hiccup in Canada in late 2008, and then it was right back to the races, and most cities now have prices at or close to all-time highs, and that's brought all kinds of bears out of the woodwork, or pessimists who suggested that we're headed for, you know, the same direction that the U.S. went, that we're an accident waiting to happen, that we're this huge bubble that's just going to burst in our faces. We do not buy into that. We do not believe that there is a bubble across most Canadian housing markets. We think that if there is a bubble in this country, it is extremely concentrated geographically. And not to name names, we think it's in Vancouver. But in most of the rest of the country, outside of Toronto and Vancouver, we think the market has actually been extremely well behaved. Toronto is a little bit of a special case. We think it has become a bit overheated, but there are some pretty good reasons for why it's become relatively strong. And we think it probably will correct somewhat in the years ahead, but I do not believe that the Canadian housing market as a whole meets the classic definition of a bubble. Now, having said that, one of the other concerns that has arisen in recent years is that because our banks have been willing and able to lend throughout the cycle, and certainly our households and consumers have been willing and able to borrow, we have now got higher household debt in Canada as a share of income than in the U.S. And just like the unemployment rate, how we've switched roles, this is also highly unusual, very, very unusual over the last 30 years to have higher debt to income ratios in Canada than in the U.S. Now, this has caused no shortage of hand-wringing among officials. No less an authority than the central bank governor, Mr. Carney, came out a little bit more than a year ago and lashed Canadians for their wanton ways and basically told us to stop spending so much and to start saving some more. And you can see how closely Canadians listened to him. as that debt ratio just kept right on rising over the last year to all-time highs. I'm not quite as concerned as others are on this front, but having said that, I would like to see this ratio eventually top out. I think we are getting about as high as comfort. But you've got to take into account the fact that we do have record low levels of interest rates, and they're likely to remain there for some time yet. Now, of course, another big factor in the Canadian economic outlook, and a factor that has weighed on Ontario, no question about it, is the relative strength of the Canadian dollar. The biggest single driver of the Canadian dollar in the last 10, 20 years has been the underlying strength or weakness of commodity prices. And a big run-up in commodity prices over the last 10 years, for some reason my pointer is not working on this side of the room. One of the big factors in that strength in the Canadian dollar over the last 10 years has been this upswing in commodity prices that we see. There is a little bit more to life for the Canadian dollar than commodity prices. Another factor at play has been globally, we are seen as a little bit of a golden child. We are seen as a relatively safe haven in this very uncertain world. So I would submit to you that at current commodity prices, the Canadian dollar is probably about 10 cents overvalued. But I think that this is a feature that is going to be on the landscape for some time. And I believe that the Canadian dollar, while it's not going to be anywhere close to as stable as I've charted there over the next couple of years, is likely to average fairly close to parity over the next couple of years. And in fact, there is some upside potential to even that forecast, given the fact that U.S. interest rates are going to remain very, very low for a long period of time, and commodity prices look to remain relatively robust over the next couple of years. Now, the good news of that relative strength of the Canadian dollar is that it has helped hold down consumer prices. Believe it or not, we actually have one of the lowest inflation rates in the world right now. It's running 2.3%. We actually get a report for January consumer prices out first thing tomorrow morning, but it's likely to look very similar to that latest result. And while 2.3% doesn't sound that low, stack it up internationally. You can see right now, even with all their problems, Europe's inflation rate is actually higher than ours is. The U.S. is up there at 3%, Britain just short of 4%, and you can see the emerging markets are all well above Canada. And the main reason why our inflation rate is a little bit below the rest of most of the rest of the world is because, as I said, the Canadian dollar is acting as a brake on a lot of imported prices. And when you're doing your medium-term planning, I think it's very reasonable to assume an average inflation rate of about 2% or a little bit higher. It's very important to remember that the Bank of Canada does target inflation at 2%. They've been targeting inflation since the early 1990s, and since they began targeting inflation, it has averaged almost exactly 2.0% on the button. And they just renewed that inflation targeting mandate last fall for another 5 years. I will tell you that they did put an asterisk with it this time. They did say that they were going to allow some flexibility, and that's sort of code for suggesting that they're not going to be that fussed if inflation runs a bit above 2% in the next couple of years. Given all the uncertainty over the European situation and the outlook for the U.S. economy, they're not going to be all that worried if inflation runs a wee bit hotter than 2% for a while. So what does this mean for interest rates? Well, the Bank of Canada meets 8 times a year to decide on interest rates, and in each one of those last 8 meetings, in fact, in each one of the last 11 meetings, they have come to the exact same decision. Very easy job they have. They've kept interest rates right where they've been at 1%, and we think that those interest rates are going to stay right there for the next 8 meetings plus. We actually do not see the Bank of Canada raising interest rates until late 2013. And of course, that interest rate is what drives your variable mortgage rates, your prime lending rates. And I realize that to some of you, that may actually be, in fact, be frustrating that interest rates remain so low and so stable for such an extended period of time. But the heavy anchor on Canadian short-term interest rates is what's going on in the U.S. U.S. interest rates have been at zero for 3.5 years running now, and they actually have so much as told us that they think interest rates are going to remain right there until late 2014. So in other words, it'll be 6 full years that the Federal Reserve is likely to keep interest rates right there at zero. And, while Canadian interest rates are not joined at the hip with U.S. interest rates, the reality is they cannot deviate that much from the U.S. for long without causing the Canadian dollar to take off like a scalded cat. So the Bank of Canada, to some extent, is beholden to what the U.S. does. Now, as I said, those are just the very, very short-term interest rates, the thing that drives prime rates. What's gone on in some of the longer-term interest rates, the thing that drive 5-year mortgage rates, 5-year GICs? If anything, we've seen something even more phenomenal in recent months. Last summer, even as the U.S. credit rating was downgraded for the first time in history, even as the U.S. was driven to the brink of default by political gamesmanship, even as there's been all this concern over the bloated debt levels in Europe, we've seen government borrowing costs in the U.S. and in Canada drop to levels that we haven't seen since the Second World War. At one point last summer, the U.S. government could borrow your money for 10 years for 1.75%, basically below inflation. Now, those interest rates have backed up a little bit in recent weeks, but they can still borrow your money for 2%. Now, we do think that eventually, over time, these long-term interest rates will creep higher. But the thing I want to leave you with here is even by the end of 2013, we are looking at exceptionally low long-term borrowing costs in both Canada and the U.S. And a lot of this is simply the U.S. Federal Reserve is doing whatever it can to turn around the housing sector, and it will not begin to meaningfully raise interest rates until they are absolutely convinced that the housing sector has turned the corner. So just to wrap it up and bring it back to the question I asked you at the start, I guess I would side with most of you who said cautious in terms of the outlook for Canada over the next year or two. And if I had to distill it down to a single sentence as to why we're cautious in terms of the outlook, it would be because governments around the industrialized world are faced with this fiscal hangover of huge government debts and deficits they've been left with. It's a little bit less of an issue in Canada than it is in places like the U.S. and in Europe. For most of Canada, they're not going to have to go through the draconian cuts that they're going to have to go through in the U.S. and Europe and Japan. But loaded on top of those concerns here in Canada is the challenge of a relatively strong Canadian dollar that our manufacturers and our tourism sector is still dealing with. And loaded on top of that is this record level of household debt we have in Canada. Now, I never like to leave on a downbeat note. The fact of the matter is I think over the medium and longer term, Canada will continue to outperform the U.S. I do think that we have a lot of inherent advantages that will come back to the fore over the medium term. We will benefit from the strength of emerging markets as a major commodity producer and exporter. Our banks are still some of the strongest in the world. They are willing and able to lend. And I think during periods of stress, that does help the economy outperform. And finally, despite all the concerns about Ontario's fiscal situation, the fact of the matter is for the country as a whole, our fiscal position is still relatively strong. So that's basically the outlook in a nutshell. Do we have time for a few questions? I'd be happy to take any questions at this point, if there are any, on any aspects of the forecast or the outlook. Any questions at this time? If not,
I think we're good.
Thank you very much.
Thanks.